So our next question comes from Bo on Instagram. Bo says, "Hey Austin and Robert, I love your content. I've been listening to you guys for a year now, and it's been incredibly helpful. I'm 33 years old, and I don't own a house yet. I'm currently saving toward that goal. Most of what I hear around financial freedom and investing focuses on a retirement that's 25 to 30 years away, which is great, but I'm really curious about midterm goals that are more 10 to 15 years away. For someone like me who wants to grow their savings beyond what money markets or high interest savings accounts offer, but still plan to use that money before retirement to buy things like a house, a boat, or maybe even a cottage or something, what kinds of ETFs or investment strategies would you recommend? How should I think about risk and allocation for these types of goals that fall between short-term safety and long-term retirement? I'd love to hear more about strategies for investing toward meaningful milestones that come before retirement." Robert, you want to kick this one off?
I would love to. Bo, this is a great question, and I really love how you framed it. Yes, we are always talking about and educating about long-term investing, but you're right. There are short-term goals you're going to want to meet, and sometimes you want to have those alternate ways to get to those goals. And that is why you always hear anyone listening and following along, here's Austin and I talk about two types of accounts, and that is the Roth IRA and the bridge account. Now, the bridge account is simply a traditional brokerage account that you have full autonomy over. You can invest in it. You can take the money in, you can take the money out, and you have no restrictions on your money in a traditional brokerage account. And I think that's where you fall in, Bo. I would really focus on getting those ETFs you talked about into that traditional brokerage account and really build that up, because then you can do whatever you want in 5 years, 10 years, or 15 years while not ignoring a Roth IRA, because I think that's super important for the long term and for retirement. But having that traditional brokerage account really crushing it is important. What would I do with it? You already alluded to it. Get those low-cost ETFs that Austin and I always talk about, the VOOs, the QQQs, the VUGs of the world. Get a mix of those, maybe some AIQ if you want to take a little more risk into the future of AI. But that's what I would do if I were you, because then that money is growing what we believe to be at the best, safest rate, but you still have full autonomy to do what you want with it in the next 5, 10, or 15 years.
So here's the exact strategy that you're looking for, Bo. If you have a financial milestone or a purchase that is more than 2 years away, save your money by investing it in the S&P 500, the NASDAQ, VTI, VUG, everything that we talk about from an ETF perspective, more than 2 years away. If it is less than 2 years away, I would begin to scale out of those investments into cash to ensure that I have the money ready for that purchase. So let's say you plan to buy your dream house 15 years from now. So you have absolutely nothing saved for it, but you're going to start putting aside $800 per month, and you're going to invest that money in the S&P 500. So throughout that 15-year period of time, it can grow for you much more than a savings account. For example, over this 15 years that we've talked about, your total contributions would be about $144,000, but the value of this account would grow to about $350,000. Now, to my point earlier, around year 13, you would begin to scale out of these investments, which means that you would sell your shares of the S&P, sell your shares of these ETFs. So when you get closer to wanting to put a down payment on this house, you actually have the cash to do so, because like we saw during the month of April, volatility is real, and it could absolutely wipe out a lot of the gains that you've experienced over that period of time. So by scaling out 2 years ahead of your purchase, you're giving yourself ample time to still earn a little bit of money by having some money parked, but you don't have all 100% of these $144,000 of contributions sitting in this account and growing, as well as the 200,000+ of profit that you've probably experienced by that 15-year period of time. You begin to pull the profit out, pulling out your contributions, and now you've got this $350,000 nest egg to then go use to go buy this dream house in 15 years.
Yeah, I just love that people are really starting to take notes and take action and really kind of lay out the plan. And then we're just here to tweak it, help, and give our insight so people can really be financially free, because that is our goal. If we can get 1 million people to become millionaires over the next 5 or 10 years through the education we're providing, then my life is complete and my career is a win no matter what else happens.
Well, I think what's interesting too about what Bo said is he very much understands the opportunity cost, right? He said, for someone like me who wants to grow their savings beyond money markets or high interest savings accounts, what strategies do you recommend? That is exactly what we alluded to when it comes to these contributions. If you just put this $800 a month into a high yield savings account, you'll have saved about $144,000 plus or minus some interest. Let's call it $160,000 total. So you'll have $160 in this account. Or by investing it, letting it grow by 8, 9, 10, 12% per year, you'll have $350. So we're talking about a $200,000 difference over that period of time by strategically investing it and being thoughtful about the risk you're taking on closer you get to that purchase.